Hi, I'm George Nordhausen. Welcome to Monday morning. We're taking a step up, I guess, in the scheme of things here. When you talk about enterprise risk management, that's what we're going to talk about today, and what it can do for you. I've heard that terminology a lot, and I've seen other people. I know a lot of agents live die with that, but I think there's a whole bunch of people that really don't understand it. Donna Gaylor is the person who's going to present this. She's written books. Well, I'll tell you. Let me tell you about her. Let's go over to so we can show you Donna's picture here, and I will tell you she is a consultant right now, but she was with Zurich for a long time. Well, she was a Chubb too, but with Zurich she had 17 years, and then she was ran the worldwide general insurance business. It was only 36 billion. Bad business, and only 36 billion. That's not too bad. But at any rate, then she started with Crum and Forster, of course, and I said Chubb, didn't I? Crum and Forster. But it was a very good background because she really understood it and got it to hear it all about it. And she saw something I guess the rest of us didn't see so fast, and that's all about enterprise risk management. She's got a book. We'll tell you about that a little bit later. But she's one of the top 100 insurance women in business insurance back a few years ago. That wasn't all bad. Donna, let's talk about I don't know what that thing is doing there. You get that off there. Let's talk about enterprise risk management. I know a lot of people have heard the terminology, but how about you giving a definition of it, if you will? Okay.
George, I would be happy to. Absolutely. Let's start with a really basic definition that is that enterprise risk management is a process. It's a business process like many other business processes, such as management by objectives or your budgeting process.
Mm-hmm.
And the goal is to better ensure that the organization will meet its strategic goals and objectives. How? By identifying the risks that might impede that goal achievement. And that's both insurable and non-insurable risks.
Mm-hmm. All right.
And then once you've identified the risks in an ERM process, then you have to quantify them, prioritize them, and then the most significant ones get reported upward, and they get addressed with mitigation action plans, which are continuously monitored, just like any other action plan that the organization might have for any of its processes.
Well, let me ask you something, Donna. What's the difference between ERM, enterprise risk management, and risk management?
I'm glad you asked that, George, because there are some differences. The first one is that in the past, risk management departments were primarily focused on insurable risks. But today, a chief risk officer is just as worried about whether or not customers' buying habits are changing or that a new technology will disrupt the marketplace and have an impact on a company's product line. So they are just, again, as interested in strategic risks, like the ones I just mentioned,
Mm-hmm.
as they are about the day-to-day risks. The other thing is, in enterprise risk management, things are not quite as siloed. There's usually a risk management committee that's comprised of the top people in all of the functions in the organization, and they're working together to try to find what the key risks are to the organization. And they also, through that effort, find correlated risks, which have often been neglected in a siloed approach. And the third thing is, the third really big difference is that with enterprise risk management today, there are very clear standards and frameworks to follow, and that wasn't always the case with risk management in the past.
Now, is this for, I got it now, but is this primarily for big businesses, or is it enterprise risk management work for medium-sized or even small businesses?
Again, I'm very glad you asked that question because I think, up until now, it has been viewed as something that the large organizations, especially the large global organizations, need to do this. But that is changing. I think middle-sized and even small businesses are beginning to realize the power in identifying their risks early enough so that you can take corrective action and avoid serious problems to your business.
Good. All right, let's talk about it. Tell me about it.
Well, how important ERM is, is part of, this whole discussion of its migration from large to smaller companies. Data was recently collected by the American Institute for Certified Public Accountants and North Carolina State University, and what that response from 1,093 surveys told them was that 68% of the boards of directors are asking for senior executive involvement to be somewhat or extensively increased. So we know that boards of directors, senior management is very, very interested in making sure that ERM is practiced in the organization. And very recently, the National Association of Insurance Commissioners have called for ERM through something called ORSA, the Own Risk and Solvency Assessment mandate that has come out from the NAIC. They adopted a model law in 2012. They issued their guidance manual in 2013, and the effective date was this year, January 1st, 2015. And this new requirement is intended to foster enterprise risk management in insurance companies. Now, this particular piece of requirement or regulation has to do with insurance companies, but I think it's a predictor or a bellwether for what we'll expect to see in other industries. So it does, again, intend for insurance companies to have effective enterprise risk management programs. Of course, it's also geared to make sure that there's a good view of the on risk overall and the capital situation of those companies. And it is required of companies with gross written premium over $500 million, and a group, if it's a group holding company, over $1 billion, and some other entities if they're in financial distress. So ORSA is alive and well in almost, I think it's in 45 of the 50 states, and those reports will be very soon sent into the state commissioners' offices for review.
That's going to be interesting, for sure. First time around, it's going to be wild, isn't it?
Oh, absolutely, absolutely. There's, people are scrambling to get their ORSA reports.
Yeah, it takes a while.
One more survey I'd like to share with you, and that is the RIMS 2013 Enterprise Risk Management Survey, which was designed to gain insight on the current state of ERM. In this case, 1,000 risk professionals were polled. In the other, it was the first one I showed you, it was mostly folks from the finance function that answered that survey. This one was risk professionals. And what they're saying is that ERM has gained critical mass. 63% of the respondents either have full or partially integrated ERM in their organization. So, this is it has grown, it is growing, and I think it's inevitable that, again, it will seep down from the very large organizations to the mid-sized organizations to the small organizations.
Right. Fascinating. Anyhow, so where do we go from here now?
Well, I would like to just say that, for all size organizations, one of the things that is important to do, I think, in helping them to consider ERM for their organization is to debunk some of the criticisms that have been out there. It's natural with any relatively new business process. There are going to be people who are naysayers. There are going to be people who only find the negatives. Or there are going to be people who are just very practical, and so they are going to be looking at both sides of the coin. And so one of the criticisms that has been leveled at ERM is that, well, it's not perfect. ERM can't identify and protect against all the significant risks or uncertainties in the business. Well, yes, that happens to be true, but I mean, it's kind of a bogus argument in that, if an organization, was able to, let's say, put in a new business process that would improve their overdue receivables and uncollectibles by 90%, not 100%, but only by 90%, would they not put that process in? If they could have a process that enabled them to forecast their profit and loss for the year and make it 90% better but not 100% better, wouldn't they do it?
Sure.
So the fact that ERM can't always identify every single risk to the organization, it's far better to have identified a significantly higher number than not to have identified any or most. So I think that that's a bogus argument. Another criticism of ERM has been that ERM focuses on the negative rather than the positive. Well, think about it. What could be more positive than a process that has as its objective to help an organization meet its strategic mission and goals and objectives? I mean, it has a positive, forward-looking trajectory, or that it's there for a reason that's very positive, not negative. Is there an upside to risk too? Yes, and sometimes there can be an upside to risk. Think about a company that notices a risk that's evolving. Maybe it's a regulatory risk that will impact their product, and they redesign that product in advance of the regulatory change, and that product becomes a wildly successful bestseller for them. Well, that's the positive side of risk. So I don't think, again, that critique that ERM is negative is really an honest one. And the third criticism that has been leveled at ERM is that it's too expensive. And George, really, I've talked to many chief risk officers. Most of them are individual contributors. They don't have any staff at all, or they have a very, very small staff. They work closely with the risk management department that was in place before, or whomever was doing risk management before. Yes, there is some cost involved in going through an enterprise-wide identification of risk, but that expense, again, at the end of the day, is one that should have a payback to the company that's far in excess of the expense. So the fact is that ERM is generally not too expensive if you look at it against the value that it brings.
Yeah, you can see it immediately. It's just very positive. What I like about it is what it's going to do for independent agents. Let's talk about that. All right.
Okay, well, sure. There are two ways to look at it in terms of why agencies should be interested in ERM. First way to look at it is, let me just go back here.
Okay.
One way to look at it is that, it can help the agency itself.
Okay.
And so it can help them ensure their own profitability and perpetuation. If they adopt it internally, they can manage their own risks better. They can show their clients, carriers, bankers, investors that they are actively managing the uncertainties in their business in a professional way. So that's one reason they should be interested. The other reason is because it can enhance their value proposition to their own clients and can help them differentiate themselves. Because if they are consulting with clients about all their risks, both those that can be covered by insurance and cannot be covered by insurance, they're offering a better overall insurance solution for their clients.
It seems to me, excuse me, Don, I was just going to say, it seems to me that that enterprise risk management is such a wonderful tool for agencies to use against I will say the direct writers, the direct sellers, the people who are selling online. I mean, this is so much. I mean, they can't do it. Those people can't do it. They have to have the human beings to do it. So I think this is a wonderful, wonderful tool. You know, you said that too, didn't you? Yeah, for the agents.
Yeah, absolutely. I mean, well, we're going to see in a minute how through this process it might lead the agency to better explore other aspects of a solution for that customer and sell other lines of business to that same customer.
Okay.
But first, let's look at the agency doing their own ERM. So, for example, we know that in today's world, if we looked at this at a macro level, most agencies will identify such risks as talent gaps. It's very difficult to find talent today. And then they would next prioritize how that risk affects them, and then they would manage it. And I like to use the acronym IRTA. How are they going to either eliminate, avoid, reduce, transfer, or accept that risk? Another macro risk that agencies are facing is competition, whether it's direct sales, internet sales. You know, competition is shrinking agency market share in many cases. So how significant is that risk for a particular agent, and how are they going to address that risk, either eliminate it, avoid it, reduce it, transfer it? If they accept the risk, what can they do in terms of innovation, differentiation, diversification, and cross-selling to make up for that risk or to address that risk?
No, well, you're saying that this is for an agency if it's doing its ERM on the agency itself.
On the agency itself.
I see. Okay.
Exactly.
Yeah. Okay. Got it.
So, you know, that's kind of, I tried to take a look at what are some of the macro issues that agencies are, or macro risks that agencies are facing today. And then the next slide, I've tried to just take a look at some of the more specific risks that a individual agency might face. So, you know, an agency X in Duluth, Georgia may be facing different risks than an agency in Columbus, Ohio. So what are those risks? And so just, again, hypothetically, it may be the business demographics are changing in the territory that that agent covers. How significant is that risk, and what are they going to do to address that risk? So if an agency goes through this process that I'm talking about, identifying their risks, prioritizing them, and then figuring out how are they going to manage that risk, they will become a stronger agency. It gives them the opportunity, again, when they're talking to any of the stakeholders that they deal with, whether it's a customer, a banker, whomever, someone who maybe wants to invest in the agency or get involved in the agency, they can say, look, we've gone through this process. We know what our risks are, and we have specific mitigation plans to address those risks.
Donna, is there anybody that teaches this ERM for agencies to do for themselves?
Well, you know, that is something that you know I have tried to do through the publishing of my books. It's something that I'm able to do with my partner Al Decker, and I'm also associated with Hanover Stone Solutions, which is focused on creating or helping insurance companies implement their ERM. So there are a lot of people in this field actually teaching the how-to of ERM.
I see. Didn't know it. I'm learning.
Yes. Okay. So now I guess you would like me to switch gears a little bit and talk about how an agency can work with their clients. I think that, you know, by taking a holistic view of risk, a client can realize the need for additional covers that haven't always been considered in the past. So if an agency is helping the client, or even just simply staying aware of what the client's ERM efforts are, then it becomes an opportunity to offer additional product lines that the client may now want. They didn't maybe realize they had a need for it before they implemented ERM, but after that, they suddenly realize, I need more than a plain vanilla BOP, or I need more than, you know, the basic property casualty covers that I was getting before. So, you know, how can an agent get involved? Well, they can get involved with the client's ERM on a consulting basis. Now that one, you know, requires obviously expertise. It requires maybe some specialized talent in the agency. It comes with some potential liabilities, and so I can understand that some agents will want to develop that expertise and some won't. But if they don't want to actually become a consultant to the client on ERM, perhaps they can just attend a client's ERM meeting so they can hear what's going on and in network and within the client's company. Maybe they come and speak at a client's ERM meeting about some particular topic that the client would like them to address. Because again, ERM is both about insurable and non-insurable risks. And certainly they can ask questions about the client's ERM efforts during the application stage or renewal stage of dealing with the client. There are many ways that the agency can get involved with the client, but the outcome that I'm predicting could happen from working with the client on ERM is that, you know, a lot of additional policies might come into play. For example, you know, product recall. Maybe the client in their ERM discussions within their own company suddenly realize, wow, you know, retailer X down the street, who is very similar to us, just got sued or involved in a product recall situation. Maybe we should, you know, we never thought we were liable, but maybe we ought to take note of that, and maybe we ought to protect ourselves with a product recall policy that, you know, as you know, covers reimbursement for financial loss and has, you know, many other features, including, you know, litigation expense. Maybe maybe that client during the ERM discussions realizes that, you know, some significant piece of equipment they have has gone off warranty, and maybe that creates a discussion around maybe we should be getting equipment breakdown insurance, or maybe they've just added a new piece of equipment that they never had before. And through the ERM discussions, they realize this is something that maybe we should be looking into. So maybe they haven't bought a cyber policy yet, but again, through the ERM discussion, maybe they even waited for the ERM discussion before they were going to make a decision about buying a cyber policy. But through the ERM discussion, they make the decision, hey, we really need to have this covered. Employment practices liability. You know, this is really a hot area right now, and you know, the awards and the costs can be quite significant, and very often this is the kind of thing that would come out in the ERM discussion about, you know, what are our risks relative to discrimination and all the many regulations that have come out in regard to discrimination of all sorts. So environmental policies, another good one that a lot of mid-sized and small companies have not bought, but they may have processes. that involve pollutants, and they really should have that cover. But once they go through that in-depth ERM discussion about what are my risks, suddenly it becomes very clear that these policies, or these covers, are very necessary. What if they've just become more globalized and they're dealing with countries all over the map, and you know, there's a lot of instability in the world today. They probably need a trade credit policy. But until they have that ERM discussion, maybe they've never thought of that. And other possibilities run the gamut from inland marine to supply chain, excess casualty, E&O, D&O, reputational covers. I just, read this morning about the Steel Re's new reputational cover that's out there. They're offering it in conjunction with one of the Lloyd's syndicates. So now there is a product for reputation, employee benefits. So actually, just to sum up, George, I really believe that if an agent's client gets involved with looking at all of their risks, they will likely come up with a need to have some covers that they've never bought before.
I expect that's right, and I think that I think a lot of agencies over the years, or agents over the years, kind of would go through all that to see, but they never really went to the until the ERM came along, to my knowledge, and they never really went to the business and looked at the other aspects of the business. They looked at the what are we insured, but they never really. Well, I don't know if I'm saying that right, because I never got into that, but all of a sudden ERM popped up, and now I understand it, I think. And I think don't you think it's awfully important that they're looking at a lot of other things that you talked about that really aren't insurable, maybe, or something, but they need to know all these things. I don't know. It's just the possibilities are endless on the thing. I'm impressed.
Well, it is, and that does scare some people, but the point is not to try to boil the ocean. It is important for anyone who's practicing ERM. This is just, I think, a really important point to make. Whoever is practicing ERM, you can't try to think of every small, tiny potential risk that's out there. You will drive yourself crazy, and you will waste the company's money. But you need to be able to look at the significant ones, all of the significant ones, whether they're insurable or not. But keep it significant.
I agree. And now let's talk about your book, your new one. That's just coming out. It's not out yet, is it? Let me see the.
It will be out next month.
Oh, good.
Just saw the last galleys. It's called Enterprise Risk Management: Straight to the Value. And this is a book that is for practitioners of ERM to help them identify how they are adding value, how ERM is adding value to the organization, so that they can, if they're getting that question from their CEO or their board or from some other stakeholder, they'll be able to answer the question how it's bringing value to the organization.
Will this book be on Amazon only on Kindle type thing, or is it going to be a printed?
It will be on Amazon as a soft cover, a hard copy soft cover, and it will also be available electronically.
I'll be darned. That's great. It's been needed so long. Well, Donna, I want to thank you very much. It's just it's enlightening for us, and I know you did another one previous to this for us, and I hope that in a few months we'll do some more, and then when the book comes out, you can tell me what are they finding, what's good, what's bad, and what's indifferent. We'll do it again. How's that?
Sounds great, George. Pleasure doing this with you.
Yeah, it is really fun. For the rest of you, well, we'll see you next Monday morning.